Welcome, everybody, to the Cash is King webinar, Optimizing Payments for Higher Revenue. I am your host, Dove Karp from Chargeflow, your go-to chargeback management solution. Over the next hour, we will learn practical strategies and real-world examples of how to improve our cash flow from the people and brands who've been helping D2C brands financially thrive while they sail through the stormy seas of e-com. Today, you'll get to hear from Kevin Leo from Numeral, Andrew Murphy from DashFi, Asa Dharari from Okora, Rayla Guber-Rappaport from Final Loop, and our very own Ram Winkler from Chargeflow. The format will be a mixture of interviews and presentations, along with giveaways and a Q&A at the end. With that being said, throughout the webinar, please feel free to send us any questions that you'd like the panel to answer during our Q&A discussion. So without further ado, I'd like to welcome our first guest, Rayla Guber-Rappaport. Rayla
Hello.
is the, hey, what's going on? I'm going to give a little bio for you, just so everybody knows what's going on. So Rayla is the head of product marketing at Final Loop. Previously, she was a CPA who spent more than 13 years with PwC before joining Final Loop back in 2021. Over that period, she enhanced her deep understanding of accounting with e-commerce expertise by working directly with hundreds of D2C and B2B brands. Welcome, Rayla.
Thank you so much. Great to be here, Dove. Thanks so much for having me.
Yeah, it's our pleasure. So we're looking forward to your presentation.
Sounds good. Let me share my screen.
Absolutely.
Second here. All right, sorry.
No problem. We should have music. Oh, here we go.
All right, there we go. Fantastic. Here. All right, you can see the full slides, right?
Yep.
Fantastic. Okay, great. So first of all, again, thanks so much for having me here. I'm especially excited about the topic because I think cash flow is one of those things that I really love geeking out on a bit. Especially as BFCM, Black Friday, Cyber Monday is right around the corner. This is something you really need to think about. So we're going to cover 3 of the trends that I've seen proven with a lot of the profitable brands that we work with in terms of ways to improve your cash flow. So first of all, for those of you who don't know what Final Loop is, what we do is full real-time bookkeeping and accounting for consumer brands. So we have a team of amazing accounting e-commerce experts that do the full bookkeeping for you using our proprietary accounting software that really syncs back to all the sources of truth, all of your different apps, and just provides real-time financial information for e-commerce, DTC, wholesale, retail, all inventory brands, and we do everything in real time, so you can really use that data in order to make better decisions. So that's really what we're going to cover today. And first of all, I guess I'll start jumping in straight into the scary truth of it all, which is, if you are cash flow blind, you are not going to make it. And, a stat that probably a lot of you are familiar with is that more than 80% of small businesses fail because of cash flow problems, especially as BFCM is just around the corner. You need to really think about cash flow and plan cash flow to make sure you prevent stockouts. And you don't want to be in a situation where you're strapped for cash and have to take external financing and end up paying interest rates of 30 to 60%. We've even seen up to 200% because you're sort of stuck. So we're going to cover 3 different ways for you to be able to find and improve your cash flow internally before kind of going to any of those external lenders. Sorry. Okay. The 3 that we're going to cover is, first of all, managing your inventory turnover. The other one is going to be kind of going through your operations and your P&L and cash flow and finding very small practical changes that you can make that would make a huge difference to your cash flow improvement. And the last one is really focusing on negative cash conversion cycle. If you don't know what that is, don't worry, I'll cover all of that. And don't worry, Dove, I will keep to my 10 minutes as much as possible. So first of all, we'll cover the managing your inventory turnover. Now, obviously, inventory management is really the main culprit of cash flow issues when it comes to e-commerce and inventory brands. So inventory turnover is a really, really huge key metric in order to be able to measure the efficiency of your inventory management. And inventory management is something that I could talk about for hours. We recently just released Inventory IQ, which is our newest inventory management system that's built into FineLoop. So this is what I talk about all day with brands. So I could talk about it with hours, but just to cover the main ideas here and how it can really impact your cash flow. It's really what inventory turnover does is it measures the ratio of your COGS to your average inventory. So it basically tells you how many times during a specific period you sold your inventory and rebought it. And here's, you have the calculation, your average inventory, which is the beginning inventory plus ending inventory divided by 2, which is over any specific period of time. And then you take the COGS divided by average inventory, and now you have your inventory turnover. Your ideal, you want to really focus on an inventory turnover of over 3. And what that means is at least 3 times during a period, you're selling all of your inventory and buying it back. And restocking it. Now, obviously, you want your inventory turnover to be higher, but too high is also not good because that means that you're not really buying enough inventory. Everything when it comes to efficiency of inventory management is about finding a balance between not ordering too much so that you're stuck with inventory getting dusty in your warehouse versus not ordering enough and then having stock out. So it's really about finding that balance. And that is really what inventory turnover helps you measure. So you really want to try to focus on ideally something between 3 and 6. I also added some FineLoop benchmarks here, which is basically a database of all the different brands that we cover. I kind of looked through all of them and saw that our lower quartile brands have benchmarks of up to 1.57, which is a little bit low for what you want. It means that they are buying too much inventory. The highest quartile is 11.6, which is also too high. You really want to focus at that 3 to 6 ratio. Now we're going to go on to the second point that you can in order to really improve your cash flow, which is an exercise that involves running through your P&L and your cash flow in order to find really small changes that you can make that can have a huge impact on your profitability. Now, this is an exercise that I've done with a lot of different brands that we work with. And even the brands that think that they're super lean going into the discussion with me, you can always find ways to improve the profitability. So I'm going to just share a couple of examples with you. In this case, this is just showing an example of a 7-figure brand. And we were just trying to find really examples of very small, easy, doable changes that can be made in order to increase the profitability. So, in this case, you have a 1% increase in AOV, and you can do this by, bundling complementary products or upselling. There's a lot of different ways that you can increase your AOV, but if you increase your AOV by 1%, just in this example, they're able to increase their profitability by 65.5 thousand, which is huge. And then, this is showing a bunch of other small examples that we found that makes a huge incremental increase, especially if you're annualizing the results. So, just by rethinking your packaging, you can end up decreasing your shipping by 1%. Or if you, rethink your ad spend, so you really focus on making the most of every dollar, you can find a place to cut expenses by 1%. Or focus on maybe outsourcing or automating certain expenses that you're currently outsourcing to labor to decrease your G&A. There's a lot of different ways to really find examples of how to do this. This is just an example of one brand, but this is something that you can do today. So like right after this entire thing is finished, go into your P&L, look at your P&L and find these solutions. This is an easy thing you can do that really increases cash flow. And then lastly, we're going to focus on the negative cash conversion cycle. So kind of just to give you guys a quick overview of what that means, it is how quickly you can turn your cash, how quickly you can turn your inventory into cash. And basically that is calculated by taking your time to actually sell your inventory, plus the time to collect your receivables, minus the time to pay your vendors. And here, this is probably one of the few times I'll say this in accounting, but here you want to get this as negative as possible. You really want this to be as low as possible, because what that means is that it takes you longer to pay your vendors for the expenses that you have by buying inventory than it took you to actually collect the money from your customers. What you created, if you can do that, is a self-sustaining business where your sales are actually paying for your inventory. So then you don't need to focus on external lenders in order to get that money in order to be able to pay for that. So that is huge. And the way to really improve that is focusing on decreasing the time it takes you to sell your inventory. If you're focusing on your inventory turnover, which we talked about before, this one will happen automatically with that. So that's good. If you're talking about the time to collect your receivables, if you're selling only e-commerce and DTC, this is probably less relevant because there'll be a very small gap between when you actually sell the products and when you're collecting your receivables. But if you're selling wholesale, retail, any B2B stuff, you have some more flexibility to play over there in terms of, thinking about if you have terms that are net 60 and making them net 30, or if they're net 30, making them net 15, just to be able to collect faster. And lastly, being able to negotiate with your vendors in order to increase how long it takes you to actually pay them. And again, going back to that example that we pulled before of that 7-figure brand. So you remember we made all those changes to the P&L in order to be able to really increase that profitability. And obviously all those changes also had an impact on the cash flow. So for example, when we increased AOV by 1%, the average order value by 1%, and not only increase the profitability, but it also obviously increases the cash flow as well. And if we're, decreasing the COGS, it's going to increase your cash flow as well. So all of that will have a direct impact on cash flow. But in addition to all of those changes, here you're going to see 2 other small changes that we made, which is just we increased the speed by how quickly we collected from customers by 2 days. And we also paid the vendors 2 days slower than we did before. And again, 2 days is super doable, super negotiable. We're not talking about 30 days or 40 days. We're talking about a 2-day difference, but it made a huge difference on the cash flow. And in this example, taking everything into account, they were able to increase their cash flow by $125,000, which again, obviously, depending on the size of your brand, it will all be relative in terms of how it impacts you. But this is a huge amount of money that they would otherwise have to take from an external vendor and likely have to pay a tremendous amount of interest related to that. So it was something that really, it's just an easy activity that you can do. It's an easy activity that you can do that really can increase your cash flow. And it's the equivalent of having like thousands of dollars of change in your couch cushions, but instead going to the bank to take a loan. First start with your couch cushions, then you can go to the bank after that. So that's basically the 3 things that I've seen, the 3 trends that I've seen amongst the profitable brands that we work with in terms of really being able to just use your internal resources to increase your cash flow. And if you're not sure where to start, I would say like the number one, you have to make sure that you have, precise real-time financials. And I'm not saying this as somebody who works as Finalip, I'm saying this as a CPA. This is, I think if you have your wrong numbers and you have numbers that are delayed or that are not accurate, every exercise you do after that is going to be, completely fruitless. So you need to really get precise real-time financials. Also with respect to your inventory management, you want to make sure that you have a real visibility into your COGS and your inventory. Once you have all of that, then you have the tools to be able to actually start the exercises of looking at your financials and figuring out where you can save money and where you can increase your cash flow. So what I always like to do when I'm starting this exercise with a brand is to export the financials on a month-to-month basis, looking at the percentage of each expense to the net sales. And when you're looking at it on a percentage, it's very easy to kind of compare and find specific gaps or major fluctuations where you can start focusing there and saying, okay, is this an opportunity for me to shave off some costs and save money and increase my cash flow? So I think that that's really the best way to start.
That was fantastic, Rayla. Very, very clear. And what it really, it reminded me of Atomic Habits. You know that book? It's a very famous book, Atomic Habits, right? So it talks about making these little subtle changes in your life that can ultimately lead to massive rewards as time moves on. And, you should actually apply that to your business, as you're saying right now. Look for the little things because they're really not so little and they're absolutely doable.
Absolutely. And one of the things I saw a lot with brands is, people are always looking for the big changes that they can make to have these like major, drastic differences in their business, but then those always end up waiting. So you're spending a year, 2 years not making any of those changes, as opposed to these small things, which you can do today and really have an incremental impact on your business.
100%. All right, Rayla, thank you so much. Where can people find you?
So you can find me on Twitter at Rayla Rapp, RaylaRapp, or you can find me on LinkedIn, Rayla Guber-Rappaport. There are not many Raylas out there, so I should be pretty easy to find. And feel free to reach out if you have any questions or you just want to geek out on some e-commerce finance, I'm always happy to do that.
Amazing. Amazing. Thank you so much for your time.
My pleasure.
Okay. All right, we're moving right to the next one. Next up, we have Andrew Murphy. So Andrew is an enterprise account executive at DashFi, where he works closely with high-value clients to deliver tailored financial solutions that drive business growth. With a strong background in finance, Andrew has extensive experience in investment management, corporate finance, and client relations. Prior to joining DashFi, he held key roles at various financial institutions, including PwC Ireland, where he developed his expertise in capital markets and strategic financial planning. Welcome, Andrew.
Great to be on board, though. How are you?
I'm doing great. I'm doing great. So you got a little presentation for us.
I do indeed. I'm just going to share my screen here.
Fantastic.
And zoom out of Zoom. And you can see that all right. Perfect.
Yes.
So I think it's probably fitting that I went after Rayla, as I guess e-commerce has a pretty significant working capital problem. And I guess the goal that she was mentioning of trying to, I guess, to flip your cash conversion cycle for an e-commerce brand can be very difficult. So why is that? Well, typically e-commerce brands, if they're young, or even if they've built up a really healthy balance sheet and they've done successful profitable years back to back, they still do find it difficult from like a credit worthiness point of view or a supplier relationship point of view to actually improve their payment terms. Let's say they're getting their stock from the Far East, somewhere like China. They'll still typically, when they're purchasing or putting through a purchase order, ultimately on day one, have to put down about 30% of that purchase order. So this graph kind of shows, day one, there's like an initial cash outlay of 30% of the PO. Then when the product is actually maybe shipped from China or it lands in a port in the US, they then have to pay the additional kind of 70% of that purchase order. So meanwhile, this business is trying to pay payroll, pay rent, pay all these other kind of working capital and operational costs. There's a huge cash outlay from inventory and then marketing spend before the brand has ever actually had an opportunity to get that shop or to get those products out to consumers, ultimately convert those prospects into customers, and then generate revenue and net cash from that. And so what the kind of card market has maybe struggled with for e-commerce and why there's been a gap for fintechs like ourselves or maybe some of the MCA providers that Rayla spoke about is that in the early days of any business's growth, they could be performing really well in terms of their marketing. They might even be able to be profitable on a first order with consumers, or if they're maybe a more subscription type company, they've got a path to profitability by showing that they have an ability to generate repeat revenue from a customer cohort. However, a traditional kind of credit card company or a bank typically isn't underwriting based off these metrics. They're not perhaps plugged into, say, your Shopify, your Amazon, your Google Analytics, your Google and Meta ads, and they're not really seeing the full picture of how your brand is performing. And as a result, you can see in the bottom left, they're having to underwrite based off things like a FICO score, which rather than showing, your potential for growth as an e-commerce company, a FICO is going to be some sort of lagging measure of your finances and probably won't reflect, your true capacity to grow and ultimately repay a lender. So in the early days, DashFi had kind of spotted that a typical credit card company might give you 30-day calendar month terms, but let's say they give you a 500K credit limit and you plan on spending $1 million or $2 million every month on a combination of, say, inventory or marketing expenses. Very quickly, those average 15 days of credit that you're getting get whittled down to, 7 days of credit, 3 days of credit, and almost to a point where people are paying down their credit card daily in order to get access to that limit. And so very quickly, these credit cards aren't actually maybe serving the purpose they were meant to do, which is to give you that kind of payment float and ultimately give you the credit that you actually want. So I guess what DashFi has done is we've kind of assessed the market, and because we have a background in marketing analytics, and I used to work for a company, Wayflyer, who did a similar thing but offered an MCA product, we tried to underwrite brands based on, some traditional finance measures like, bank balance, cash run rate, cash burn, things like that. but ultimately we want to understand the actual velocity and amount of payments going through your credit card every month. And if we can understand that while also understanding how you generate revenue, how profitably do you market your product, and how can we forecast your ability to generate future sales? And if we can have confidence in you doing that, that is what will give us confidence to give you much higher performance-based limits than maybe a traditional credit card company might. No personal guarantee, which I know is a huge bugbear for founders, given that they're placing, a huge amount of risk when putting their name to a lending product that can traditionally go wrong. And also there's a cashback element to DashFi, which we can talk about at another time. So I think going on to kind of complement Rayla's points, what kind of product or solution could really help these brands? Rayla mentioned MCAs, which, I used to work for a company that offered them. I think they serve a great place in the market, but at the same time, the APRs can be very high, ultimately, hurting or potentially hurting a brand's P&L. But one of the other more damaging things is that they do start taking repayment as soon as they give you the cash. So if we go back to the previous example where, we give a brand cash, they need to pay 30% of it on day one, maybe the remaining 70% on day 30. It might take them, 2 months to generate any revenue and net cash. Whereas an MCA provider might start taking a portion of your sales straight away, which is kind of having like a counterintuitive effect on their cash flow. So what DashFi are trying to do is really just offer like a net 60 option, i.e. whatever you spend on the 9th of September, we would debit from your bank account on say the 9th of November. And as a result, we're giving brands the opportunity to actually have 2 months to get their hands on that product, market it efficiently and profitably, generate the net cash from it. And as a result, the net 60 option is freeing up cash flow for maybe more strategic things like hiring someone during Black Friday, Cyber Monday, or spending more on that advertising campaign, whatever that might be. So again, just to kind of, I guess, reiterate, it's very much performance-based limits, and the limit scale, flexible terms. And I think the Cozy Earth example kind of maybe hits home. Last year, I essentially worked with a brand, Cozy Earth. I think they're a bit of a darling in e-commerce and that they're doing probably, multiple 9 figures in revenue, and ultimately their peak spend days come in Black Friday. So a brand like Cozy Earth could do, 60% of their revenue in November and December. And as a result, their credit needs are going to be different in November compared to what they're going to be like perhaps in March, April, when they're having a bit of a slow season. If they were to go to a bank or like a traditional provider, they're not really going to be able to maybe increase their limits without having to go through a very timely, intensive underwriting and probably very highly securitized underwriting process rather. Whereas they came to us and they'd given us an assurance that, they were only spending, $1 million on Black Friday. It turned out they hit their million spend at about 9 a.m. Eastern on Black Friday. Such was the pace and success their media buying team was having. And so if they were to go back to a traditional provider and request a credit limit, they wouldn't have got it turned around on Black Friday itself. Whereas because we had seen their ad performance, we could see how well it was performing that day and had in the past, we were able to bump up their limit on that peak spend day. And they actually requested 2 limits in order to get up to 1.5 million just for that particular day. So why is that important to the brand? Well, if they hadn't got access to that credit limit, that customer can't probably just be marketed to the following month and hope they convert to a customer. And you're ultimately missing out on like multiple months of potential lifetime value from missing out on that customer cohort. But their ability to get flexible access to credit on peak spend days has a huge knock-on effect as to whether they capture certain customer cohorts or potentially miss out on them for life to them just not really liking the brand or perhaps going with a competitor or wherever that might be. So that's probably the best use case for a DashFi, either card or a net 60. And there's a few perks that go with it, including, a very strong cashback anywhere from 2.2 to 3%. But I think the main kind of value add for founders is that they do kind of see our card as like a set it and forget it. Due to a MasterCard backing, we've got, really good card authorization. we've got those flexible limits. And so brands will never have to stop their rate of media buying to go in and manually pay down cards to get access to more credit. We very much work on like a data approach while working with the brand to ensure that those limits are set up so that they can acquire as many customers as they can and ultimately become as profitable as quickly as they can. So appreciate you hosting me there, Dov, and any questions, feel free to ask.
Yeah, no, that's fantastic. I mean, the liquidity of cash is incredibly important, especially when you're running campaigns and you got to raise limits and all that stuff. And it's amazing that this didn't exist beforehand. You have to pay it down and all this stuff. It sounds like a really great product, and I'm sure our viewers are gonna love it. You should definitely check it out. Andrew, where can people find you?
Yeah, so my email is andy@dash.fi. If you search the dash.fi company, you'll see an Andrew Murphy in there. There's not too many Irish people in the company, so you can filter by Ireland if you like. I'm also on Twitter @Andy Murphy, but there's about 5 Y's at the end of Murphy because I think it's a pretty common name. So you can find me on any of those. I'd be happy to chat with anyone about cards, payments, anytime they like.
Awesome. Thank you so much. I really appreciate your time. Right now we have giveaway number 1. So the winner of the $100 gift card to your merchant of choice is Sofia Rivas. That is Sofia Rivas. Congratulations. Our team will be in touch with you after the webinar. Moving right along, we have Asa Dharari. So Asa is the VP Advisory at Okora. He's assisted corporations for the past 17 years in the fields of financial risk management and complex derivatives for transaction and reporting purposes. Asa is an avid traveler, and maybe that's why he likes to follow the currency markets. Asa, welcome aboard.
Great seeing you, Dov, and thank you for having me.
Yes, it's our pleasure.
Maybe currencies are too much of a hassle when you're traveling, but I'll try to set up my presentation.
Sure. Yeah, well, I'll while you're setting it up, I recently was traveling, and unfortunately, because I haven't traveled in quite some time, I went to another country. My card kept on getting blocked, and that was quite annoying. So, to make sure that you have your all that squared away before you go away.
Yeah, it's one of those cross-border cash flow problems, which I'm going to talk about in length here.
Fantastic.
I'm going to talk about something a bit different than Rayla and Andrew. I'd like to discuss cross-border cash flow scaling, which is very relevant for businesses, especially small and medium-sized businesses who want to go global, want to have better relations with foreign customers or pay their foreign suppliers more efficiently. And there are 2 aspects to this. First one is setting up the correct infrastructure to do it optimally and with as let's just say minimal cost as possible. But the other one, which over time is the major headache, is dealing with exchange rates. Now, I've got here set up a lot of companies, and I could probably put here about 100 more. But what's all these have in common is that over the years, they mismanaged some of their currency-related cash flow, which means some of them experienced severe losses, some of them experienced bankruptcies, and I think the most common thing here is it pretty much delayed or derailed their ability to expand globally. Now, it's not easy. About 49% of all importers and exporters, small ones in the US, feel difficulty expanding globally because of complexity concerning handling cash flow. Now, most of them work with banks. They're being overcharged. Money is transferred too slowly, both incoming funds and outgoing funds. They find it very difficult to process large number of transactions, especially relevant for e-commerce. They get ripped off concerning exchange rates. They get hurt when exchange rates fluctuate and are very volatile. And it's very, very difficult to plan the cash flow ahead. Now, all of these problems translate to the need to address payments, international transfers, etc., but also the currency element. Now, pretty much you have two basic challenges here. First of all, operational challenges, which means setting up multi-currency accounts with banks, especially leading banks, maybe setting up local accounts all over the world. There are, of course, accounting challenges and transfer challenges. You can transfer funds, it might take you days sometimes, which is very difficult. You might expect to receive funds and not know exactly when to receive them. I have experience with clients that have to pay literally weeks until funds got to their bank account after they were sent by their clients abroad. But there are also financial challenges, which mainly deal with currency. Again, exchange rate conversions, which might be difficult, and exchange rate volatility, which is something we experience all the time, which means from a cash flow perspective, usually small companies that deal with banks find that it's expensive, it's low, and the cash flow is certainly unpredictable. And from a risk perspective, after everything's set up, currency is still the major concern here. Now, as I said, for SMBs, it's even more challenging than that. SMBs, as probably everyone knows, can't afford any fancy ERP or accounting systems, don't have their own dedicated treasury teams. They're usually not treated very well by their banks. And they generally don't have the resources to deal with it all. Now, this translates into plenty of statistics, which I have here on the slide. What's important to say about that is it's completely an international problem. It's not unique to North America. You can find it in Europe, in Australia, and pretty much everywhere. Now, how can you turn that challenge into an advantage? Today, thankfully, mainly because of the fintech sphere, you can build an international financial presence pretty much everywhere, very, very quickly, and also very cheaply. Now, there are four major problems that this ecosystem can address. First one, which is usually very, very difficult for small companies, is gaining an international footprint, banking footprint. If you're not served by a first-tier bank, it's very difficult to get local accounts elsewhere and around the world. But now you can rely on non-bank infrastructure. Payment companies, which are readily available all over the world. You can open multi-currency accounts and also local accounts in, as far as I know, at least 50 countries, which gives you a real global outreach here. The second problem is your treasury and accounting operations, which means pretty much handling the cash flow. Now here, again, you have solutions that can connect to your existing accounting software and your inventory and your CRMs and connect that to your bank information and streamline it into one continuous workflow. That's, by the way, one of the things we do in Okora, but there are also other companies that do it. It's very important, and it saves a lot of hassle. Third challenge is too many tasks, especially for a small company, and too much data to handle. You have to follow not only your own clients and your own products, but also the different markets and different exchange rates. And you have to handle too many interactions with your bank. The solution here simply is automation. A lot of those simple tasks, especially concerning accounting, but also treasury tasks of converting currencies, sending them, can be done either fully automated or semi-automated. And the fourth concern is exchange rates and exchange rate risk. What happens is suddenly, you're a dollar company and suddenly the euro depreciates or appreciates, or you have to deal with some sort of more exotic currencies in South America or even Africa. Here, you can rely, again, on fintech infrastructure from different companies, which spans all continents, and can give you also hedging solutions, which enable you to lock rates and protect your incoming cash flow, and also ensure your outgoing cash flow to your suppliers in a smart way and a very relatable way. So what I'm trying to say here is, by leveraging novel fintech solutions, you can bypass all the constraints you used to have by working with traditional banks. It's a real game changer. And I can say from our experience at Okora, we've helped a lot of small companies and medium-sized companies achieve global presence, especially in terms of receiving global revenues. So now I'm going to have a small video explain what we do here in Okora. So I'm going to leave 70 seconds of your time. Okay, thank you.
Asa, thank you so much. That was a great presentation. And definitely, my wife works in one currency. We have to always transfer over. And, you know, literally the day before, you're like, wow, this is a great rate. Can't wait to pass that one over. And then all of a sudden, 24 hours, you know, it drops multiple points and you're like, oh my gosh. So for businesses, they also, you know, have these big problems, especially for the smaller businesses. So it's great that this exists. I just had a quick question about AI, and I wanted to know, you know, how does AI potentially improve the cross-border cash flow and currency management?
Well, I can say that in our sphere, it's been a real game changer. I think for the first time, smaller companies, but also fintech providers like us, could harness AI first to optimize our operations. I mean, routing the payments the best way possible at minimum cost and minimum time. Handle large amounts of data. You know, we deal in currency markets. A lot of our clients deal in multiple markets and have a real problem following currency fluctuations. And, you know, it's a full-time job. And AI helps condense all that data very quickly and very effectively. And I can say from our perspective, it also helps us, our system advise our clients, I think, better when it comes to hedging and paying their suppliers in foreign currency.
Amazing, amazing. Well, that sounds great. It sounds like it's a very bright future for that market specifically. Asa, where can people find you?
You can find me on LinkedIn or my email, asa@okora.com.
Fantastic. All right, Asa, thank you so much.
Thank you.
We're going to move right along. This one's near and dear to my heart. I mean, you all are, but especially this one. Next up, we have Raym Winkler. So Raym is the CFO at Chargeflow. He brings over 15 years of experience in finance management, accounting, and forecasting. A CPA by profession, Raym spent nearly a decade at EY, working across Israel and Boston before transitioning to software startups. For the past 6 years, Raym has been guiding companies from seed stage through growth. Outside of work, Raym is an avid swimmer and mountain biker. Raym, welcome to the show.
Thank you very much, Dove, and thank you for the audience for being with us. It's my pleasure to be here, and I hope you enjoyed the show until now. I hope I will not mess it up.
No way. Coming to the climax is the peak.
Yeah, so people tend to think that the CFO is a chief financial officer, but we are also chief fun officers. So we will try to do in the 10 minutes that I have to present why the cash is so important and why cash is king and Chargeflow is the queen. So I will present my screen. You see it?
Yeah, we see it.
Great. Just move the camera here. Great. So basically, what's so important that we are a financial executive think on cash as one of the most significant KPI, and I want to walk you through our way of thinking about cash and other, of course, KPI in order to make one cash to a lot of cash in the terms of our companies and of course as a private perspective. So we will cover, of course, intro of Chargeflow. We will discuss why cash is king, liquidity in changing market, investment opportunities and growth initiatives, and of course, to discuss a little bit about risk mitigation and operational excellence. So what is Chargeflow? So Chargeflow is basically a dispute automation management that basically prevent and mitigate chargeback. What is chargeback? It's basically think of everyone that performing a transaction, usually online, in most cases is using his credit card. By the end of the day, he's receiving something, he's receiving service, he's receiving product, and he decided this is not enough for him. He wants to dispute the transaction because he don't like the product, he thinks that he never received the product. There are many dispute reasons. When an e-commerce or any other brands receiving this chargeback, is basically need to fight back. You need to say, oh, it's not, I just shipped your inventory. I just spent a lot of money on this transaction. Why are you disputing my transaction? And then he need to sit down and spend 2 hours from his time to writing down why this transaction is legit. You need to explain it to the issuer bank. And this time, and it doesn't have the expertise, it doesn't have the knowledge, it needs to contain a lot of data from a lot of data source, from terms and condition, story about the company, story about the transaction itself, information of communication between the end user and the customer success, customer support. So this is something that creates a lot of hassle to any business that's selling their product online. And how Chargeflow support it. So basically, we collect a lot of information using digitalization, using automation, using AI, and using our expertise that we collect during our time from, of course, knowledge and, of course, literature. And basically, we provide on behalf of the merchant a dispute reason, a dispute case that basically go to the issuer bank, and we are waiting for the result. So we're basically replacing the human time and effort that they are spending. And of course, we increase dramatically the winning rate. So we have two effects on the cash. One, we're increasing the winning rate. So there is more cash coming into the company. And secondly, we are reducing the time of spending on those cases. Who is our typical clients? So basically, as I mentioned, it could be anyone that's doing a transaction online using credit card. It's not just e-commerce. It can be travel, hospitality, digital goods, a platform, subscribers. It could be everywhere. Everyone that can use the credit card. So basically, what is that doing? We are reducing the overhead and improving the gross margin by basically providing. And it's not just that. Think about it, the chargeback, it usually tends to taking your money. Once there is a dispute open, it's basically the processor saying, guys, we are checking this dispute. We're holding your money. So you're not getting your money back to your account. On that time, it could be between 1 day to 180 days. This money is frozen. So this is additional thing why we help the money is coming faster to the merchant. And of course, by the end of the day, knowledge is power. Okay, in most cases, when you work with couple of processors, couple of stores, you don't have the integration, the consolidation of the information. So we provide a one screenshot that provide a lot of insights and provide what is the status of the chargeback, and not just the chargeback, also business insights. Why we think the money or the cash is so important? By the end of the day, time equal money. Time is the most expensive resource that we have. If you will ask anyone, okay, we are living here on Earth, and our time is the most expensive thing that we have right now. Not the money in the bank, the time. So we need to invest our time wisely, okay? Not to waste our time on things that automation and digitalization can help us to do. And we need to spend our time on new initiative. We need to bring more money to the company or to our personal lives. We need to think on new ideas, how to scale our business, how to improve our life being. So more ideas, basically, and more initiative will drive additional outcome, additional money, hopefully, cross finger, and boom. If cash is the king and cash equal time, use your time and your cash wisely in order to scale up your cash. Let's discuss about liquidity. What is the optional that we have currently in the market? So basically, the most common thing that we can do, we can prove and optimize the net positive cash flow. What is net positive cash flow? By the end of the day or week or months or year, it doesn't matter when, you want to see what is the net positive. There is money coming in from your clients, there is money going out from vendors, and you want to see what is the net. It's need to be a positive transaction in order for you, if you don't have any other cash option, it's need to be positive. If not, you cannot go to grocery because you don't have cash by the end of the day. So we need to improve. So we need to improve the revenue to get more cash in from our clients, and we need as much as possible to reduce the cost. The second option is to go to our parents, to our grandmother, and knocking on their door and asking for money. Guys, we need money to support our business. We can go to an angel or a venture capitalist to look for external source of money in order to support our business. And we also can go to the bank and ask for a debt or loan in order to ask additional money. Why it's so important to bring additional money? I'm a big believer that $1 can bring you, by the end of the day, much more than the $1. So invest your money wisely, okay? By the end of the day, if your product is a market fit, you need to do a lot in order to make it scale and go to market. It's, of course, related to seasonality. If you invest in winter stuff, you're not going to selling on the summer, right? It's also related to the consumer behavior. If someone tends to buy, for example, more stuff on specific area, you need to understand the behavior of your clients. And of course, quick adoption. And this is why it's so important to have cash. You need to invest upfront in some area. First of all, in order to bring additional clients, you need to invest in customer acquisition. It could be marketing initiatives, it could be sales initiative, it could be a lot of things that can create additional funnel of your client base. So you need to invest in marketing, you need to invest in inventory. In some cases, you need to inventory in advance in order to send it to your clients because they want the inventory now. They don't want to wait until you will get the inventory from someone else. And of course, there are a lot of operation in advance. You need to have a team in place. You need someone to take care of the order and everything. So what is the improvement that we can do in order to improve the cash status? So first of all, ask the cash in advance if it's possible. If you're not sending the inventory, did you not get the cash in advance? Improve churn. In most cases, to lose a client costs you more than to bring new clients. So you need to very look on what is the churn rate and considering it's very high metric of yours and to spend a lot of time and efforts to understand the reason. And of course, the two basic one is to increase revenue and to reduce costs. Risk mitigation, by the end of the day, data is power. In most cases, especially in our job as CFOs, we need to know the facts. We don't count on assumption or think that could be. We want to know what's going on. We can, based on what's going on now, we can estimate it what will be in the future, what's working, what doesn't. So we need a transparency of the business. So this is very important to collect a lot of information that you have in a couple places in one place in order to have visibility of the business. Once you will have this visibility, it will help you to make smart business decision, when to invest your time and where to invest your money. Super important. And the most also very important is to have focus. If you defocus, it sometimes will create a lot of chaos in your business. So the insight, the data will give you to focus whatever you think is most important things to do. And how Chargeback is by the end of the day and Chargeflow support this initiative. So we have the insights of all the chargeback from couple platforms and couple processors, and we provide a lot of insights. What is the dispute rate? Where you're sitting? Why there is? Maybe we need to improve the terms and condition. Maybe we need to improve the delivery shipment. Maybe we need to do something. We can have a lot of insights and a lot of data related to our pipeline. So thank you. It was very, very brief because I have only 10 minutes, but it's very important and very something that touching my heart, the cash.
Great. Thank you so much. We know how much chargebacks mean to you. I hear it all the time. So I just wanted to know, when you talk about ROI in the world of chargebacks, you talk about time, you talk about, the cash flow. Can you explain just a little bit about what happens when brands really do pay attention to their chargebacks instead of just saying, you know what, I'm just going to eat it. It is what it is, just a cost of doing business. Can you explain a little bit about the ROI?
Yeah, definitely. So you'd be surprised how many merchants, how many companies prefer not to do nothing, just to have, oh, this is a chargeback and there is nothing I can do. There is a ton of clients. And once we are getting in a second, the ROI is very fast because there is nothing was done. And if it was done like by one person that was not expert in the field and it took a lot of time, in our research, the ROI is like 300%. It's crazy how much money you need to, first of all, think how much money you invest on marketing activities, in the customer acquisition, on the inventory, on the time that you spend. Think how much time was dealing with this chargeback process that was basically disappeared because someone decided that it was disputed. So we, in our research, 300% ROI, this is what we aiming to do, and this is our results.
Awesome. Raim, where can people find you?
They in six days of the week, and they can find me in the office, but they can find me in my email is ramw@chargeflow.io, and also, of course, in the LinkedIn, Ram Winkler. So see you there.
Awesome, Rim. Thank you so much. We are moving now to giveaway number 2. The winner of the next $100 gift card to your merchant of choice is Michael Reichman. Michael Reichman, congratulations. Our team will be in touch with you after the webinar. And we're going to move now to our final presenter, Kevin Leo. Kevin Leo is the co-founder of Numeral and a licensed CPA with a background in economics from UC Berkeley with a focus on accounting. Kevin started his career at KPMG, where he gained valuable expertise in finance and accounting before transitioning to entrepreneurship. He co-founded an 8-figure Shopify brand, successfully scaling it in the e-commerce space. Now, through Numeral, Kevin is leveraging his accounting and operational skills to help businesses optimize their financial strategies. Kevin, welcome to the show.
Awesome. Thanks, Dov. Appreciate it.
You got it. You got it. So we're looking forward to your presentation.
Awesome. So I'm just pulling up the slides right now.
Great.
Cool. Again, thanks for having me today. Today's topic that I wanted to talk about, which is also near and dear to my heart, is sales tax, specifically in the context of e-commerce. And I guess for this presentation on like how we could potentially optimize revenue. Thanks for that introduction. But I just wanted to provide some background again to show you guys why I am like uniquely qualified to speak on this topic. So as Dov mentioned, graduated from UC Berkeley with an emphasis in accounting. I was a licensed CPA for a long time working at KPMG. When I graduated college, I think I took a fairly traditional path, right? Went to Big Four accounting, got my CPA, decided to try my hand in entrepreneurship. And, like most college grads at the time, I did like a quick Google search to see like, hey, how do you actually make money online, right? And that's when I landed into the realm of e-commerce. From the e-commerce experience, I've done everything from drop shipping, wholesaling, and as Dov mentioned, even created my own brand. And it was during when I created my own brand where I uncovered like this issue of sales tax and kind of came full circle to say, hey, this is actually one of the biggest headaches someone deals with when operating their store. So I guess to the audience, I know what it's like to walk in your shoes as an operator. I was one for a very long time. But today I wanted to show you guys some of the details of sales tax and how you could potentially optimize it for your purposes as an e-commerce merchant. So real basic, I just wanted to lay some groundwork to show you guys some very super basic definitions related to sales tax. So for most of you guys probably are familiar with sales tax in your day-to-day lives, but just as a proper definition, sales tax is simply a tax imposed on the sale of a good or service. Pretty straightforward, right? But how is sales tax actually regulated in the United States? Sales tax is actually regulated on the state level, not the federal level, right? And so there are 45 states in the US that currently charge sales tax, 46 if you include the District of Columbia. But to further complicate the issue of sales tax, there's all these like local variations that you have to like levy on top of it, right? So think about all the different cities, counties, special business districts, where you can actually muddle like this idea of sales tax to say, hey, like what is actually the correct rate to charge, right? And so Alaska is one of those really complicated examples that we like to point out to where, there is no sales tax in Alaska on the state level, but there are local jurisdictions that actually do charge sales tax. Why is sales tax so hard? I wanted to provide a fairly jarring example why sales tax is not exactly black and white, and there's like tons of room for interpretation, right? And so the question that we like to ask is, how do you actually tax edible underwear, right? And so in some states like Minnesota, clothing is tax exempt. But if the underwear becomes edible, does that make it a food item or a clothing item, right? I know this is a pretty crazy example, but I just want to show you guys how murky and confusing sales tax can actually be. So this is a very interesting question. When we typically think of sales tax, it's typically a matter of compliance, right? But is there such thing as sales tax strategy, right? Can you actually optimize it kind of like income tax to sort of not pay as much? The answer is a lot more nuanced. It's not very binary, and the idea, and hence why my answer is kind of. But I'll explain what I mean by that. The first thing when it comes to sales tax, the immediate impact that you can have on sort of like your fiscal, your financial ledger, having the most prudent fiscal responsibility is just pay sales tax on time, right? And so sales tax in the US, depending on the state, is typically remitted or paid on a monthly or quarterly basis, right? And so when you're looking at this, though, the nuance here is that there are some states, when sales tax is due, it's typically due on the 20th of the following month. But if you actually start remitting and initiate the bank ACH on the 20th and the money doesn't land until a few business days later, it's actually considered a late sort of remittance or a late filing, right? And so it's just understanding all the very specific rules that each state has. What do they mean by actually paying on time, right? And so there's some states like California, for example, the penalties are quite severe. It's actually 10% of your total tax remittances for that period, right? And so some states, for example, if you are a quarterly filer, you actually have to make prepayments every month, right? So just understanding there are nuances, even there are details in the rules that you have to understand to say, hey, what is considered a properly on-time payment when it comes to sales tax? The next definition that I want to give is this concept of nexus. And what do we mean by that, right? And so it sounds like a very complicated word. Some of you probably aren't familiar with this, but in the US, you can achieve nexus by two ways. It's either physical or economic, right? And so nexus quite simply means that if you establish nexus in a state, you are required to register, collect, and remit sales tax into the state. And so I'll give a more detailed definition in the following slides. So prior to 2018, if you only had to pay sales tax if you had physical nexus, right? And so you sort of establish physical nexus by having an office, by having employees or contractors in specific states, or if you store inventory in that state, right? And so again, it's further muddled by the idea that if you're selling on Amazon, if you're doing Amazon FBA, if you have inventory going around to all the Amazon fulfillment centers, that technically allows you to have nexus in all those various states, right? And so physical nexus is just one thing to remember. The second part of nexus is something called economic nexus. So the landmark U.S. Supreme Court case, Wayfair versus South Dakota, in 2018 established that if you sold enough into a state, you don't have to have a physical presence there. You still would have to start registering to collect and pay sales tax, right? And so it's typically based on various thresholds in different states, but it's a various combination of having the right amount of sales volume in that state and establishing enough dollar amounts into that state. So I'll give you the example. In the state of Illinois, in a calendar year, if you do more than 200 orders into that state, then you technically establish economic nexus. In California, there's a dollar threshold. So if you do more than $500,000 in a calendar year, that's when you actually establish nexus in California. So armed with these two sort of like definitions, and specifically the definition of economic nexus, one thing to understand is your transaction volume kind of depends on what you're selling, right? And so in some states, like I mentioned in Minnesota, where clothing is actually tax exempt, those transactions won't factor into your sort of like nexus thresholds for economic nexus. But I'll give this example of a client that we have. If you sell food into a specific state, sometimes food for a specific state is actually not taxable because it's considered a grocery item, right? But if you actually tweak your sort of product offerings and you start selling merch, you start selling clothing with your maybe a fun t-shirt design, you can actually trigger nexus by that. So just being very, very careful on the type of products that you select for your store, I think will sort of have ramifications down the line to say, hey, do I actually have economic nexus in the state? So I think for some clients, understanding what your core product is, and then ensuring that, hey, if you want to sell merchandise, if you want to sell something that is taxable, be very careful about thinking about long-term effects of like, what are your sales tax ramifications? So as I mentioned, the question here is, where should you actually keep your sales tax money and the dollars that you actually collect? And so again, sales tax is typically paid out on a monthly or quarterly basis. One very interesting thing is you can actually leverage different accounts to say, hey, for example, I know Brex is an online bank account. If they pay about 4.5% on their checking account. So actually having all your sales tax dollars stored in a sort of like tax or an income generating account is actually a great idea. There are also, there are some states that actually you have to remit sales tax on a semi-annual or annual basis. So you can actually keep all your sales tax dollars in an account that's generating you interest for a long period of time and potentially make money off of that, right? And so again, just understanding putting your money in account, putting your sales tax dollars in an account that actually helps you make money, I think is a pretty prudent idea. And it's a way for you to actually accrue interest on these dollars that you're holding on behalf of the state. So lastly, the question is, how do you actually do sales tax? Like how do you become compliant, right? The first thing you can do, obviously, if you just wanted to do it yourself, if you didn't have too many states, DIY is totally an option, right? So let's say you're just starting off, you only establish physical nexus in your home state. Just understanding the details of how do you file in that state would be a good primer for you to understand what to look out for in future sort of like professional service offerings, right? You can also go to a professional accountant, for example, right? So I would assume most local accountants probably know how to file in their home states. Some professional accountants actually can file in even more states. And lastly, there's an option to use like a managed service such as Numeral, where we actually take care of all your sales tax nexus monitorings for you, help you paying on time, help you identify, are you actually setting up your Shopify store, your WooCommerce store correctly to actually charge the correct sales tax rate. Cool. So one of the things that we wanted to offer just to the audience is that if you guys wanted to have a Nexus study, go ahead and scan this QR code. We can actually provide a complimentary Nexus study for any store. We can give you a rundown to say, hey, this is where we think you should be paying. And, depending on sort of like your tax exempt product selections, we can go from there and have a discussion. Awesome. That's it for me. So Doug, I'll pass it back to you.
That was fantastic. I think most stores or most businesses aren't fully aware of how the sales tax actually affects their business. They see it at the end, but they don't necessarily know that there's strategies that you can deploy in order to kind of maybe make a little bit of money here and there. One of the actually questions I wanted to ask you was, you said you can establish your nexus physically or economically, I believe that's what you said.
Yep.
What happens if you pass a threshold in multiple places? If not just one.
If you pass it in multiple.
Yeah.
Yeah. So sorry, your question is, if you establish Nexus in multiple states, you technically have to register with each state you established Nexus. So you are obligated then to actually collect sales tax, set up your store to collect sales tax in that region, and then remit it on potentially a monthly or quarterly basis, whatever the state mandates.
But you only pay taxes you would now have to pay taxes in that specific state for only the products that were sold in that state. Or do you have to pay it on all of them?
Exactly. So it depends on where your shipping location is, right? So if you ship a product into, let's say, the state of Illinois, and you've established economic nexus, you would actually have to pay sales tax for only the orders in Illinois to the Illinois jurisdiction.
Gotcha. All right, that's very interesting, because that potentially can affect where you're marketing, where you're trying to sell your product, and it's very, very interesting. Kevin, where can people find you?
Yeah, so you could find me on LinkedIn, first name Kevin, last name Liu. You can look us up through the Numeral LinkedIn page. Also on Twitter, my handle is Mr. Kevin Liu, and you can find me there as well.
Awesome. All right, great. So now we are going to move on over to the Q&A section. We're just going to ask one or two short questions, but this is presented to everybody. And I think it's very apropos personally and also professionally in a business. When you're faced with two potential options, right? Should you make more money or should you reduce your budget? What's the main focus? Like if you only, I mean, you should try to do both, obviously, but where does the heart lie? Should I just, let me try to make more or, cut spend? I see you, Raim, smiling.
It's an open question. It's like my daughter asking me, what do you prefer, my mother or my father? It's pretty much as a CFO, it's always you need to look on what you want to achieve. If you're in time of line that you can scale the business and you can invest the money and $1 can bring you at least $3, go for it. This is the right time to do it. You need to find the alternative, the investment that can help you to do it. If you're not in this position, you need to look back and to see how to optimize your cost, how you can improve your bottom line to optimize. By the end of the day, this is the two scenario that you have in front of you. So there is no clear answer. It really depends where you're sitting and the momentum that you have.
Gotcha. Anybody else?
One thing I'll add to that is I don't think that they're necessarily mutually exclusive. And I think obviously, every company has to kind of think about what their long-term objectives are and really think about how they can meet those goals. But I've seen situations where, you've had I've seen brands that are, let's say cash strapped, so they decided to reduce some of their ad spend a bit, and they actually ended up being more profitable at the end, even though their top line revenue was reduced once they scaled back on the performance marketing, because it also reduced the rest of their costs, so their overall margins were higher. So I really think it's about looking at the big picture and kind of seeing if you have a way to do both, because sometimes they're not necessarily mutually exclusive. But ultimately, it really does also depend on looking at the long-term goals. If your long-term goals are looking to exit and you really want to increase that top line revenue, then you're not going to want to do that. If it's really about increasing your net profit or your take-home pay, then it might be a better idea to do something like that. So I think it's a big picture question.
Nice. All right. Thank you.
But yeah, I want to add a small thing. There is a rule of 40. There is a lot of investors looking on the rule of 40 is basically to take your growth versus your profitability. If it's above 40%, you're in the right direction. So it's not just a couple years back, investors look only on the revenue increase. They spent a lot of money. I want to increase no matter what. Now in these days, this is what they're looking at, growth of the revenue plus the profitability of their business.
Yeah,
Awesome.
just to add to that, I think the question here is what you can do if you want to get very technical on the accounting side is this is really a question of your contribution margin analysis, right? So is it worthwhile to actually launch a product? How profitable is it for you? And I think this is a question of opportunity cost to say, hey, is it worthwhile or can we divert these funds elsewhere, right? And so I think that's something worth exploring if you're an operator.
Awesome. Thank you. And now let's kind of phrase it more like this. So what are the most critical financial metrics that you think kind of people who are just starting out in e-commerce, these are the metrics that they really should be focusing on right now towards the beginning? Anybody?
Yeah, I have a lot of KPIs. So first of all is how many clients do you have? I think it's the first metric that you want to look. If you have more clients, it's a good chance that you will have more income. Second one is, by the end of the day, how many transactions do you have? So clients versus transaction, this is the two KPI. I will also look on the churn metrics. And what is what we call in the financials aspect is CAC versus lifetime value. So how much you spend for bringing additional clients and how it will, by the end of the day, convert to real money. So I think this is the three, and of course, cash.
Why is it king?
I think also, obviously inventory turnover, which I spoke a bit about before, but also contribution margin, I think is for sure one of the most important metrics for e-commerce businesses, because, you know, you can, first of all, it impacts your pricing as well. When your contribution margin, right, is how much you actually have left to cover all of the other expenses after you take into account any variable expenses. So after you take into account your product costs, your shipping, your merchant fees, you know, your ad spend as well, your variable ad spend. So you really want to think about what you actually have left, because if not, you can get into a situation where each sale can actually cost you money. So you really want to think about making sure that every single order is profitable, and the only way to really do that is to focus on the contribution margin. So I think that one is really, really important for even from day one to focus on.
Okay, great. And now the last question, you've seen each other's presentations, presumably. Is there anything that you're like, oh man, I have this to say? There's something that just, you know, jogged your mind, or anybody out there? No? Okay. You all gave fantastic presentations. We really, really appreciate your time. So I'm going to give right now, we're just going to do one more giveaway, and then we're going to work our way to the end. So the third giveaway of the $100 gift card to your merchant of choice is Caroline Kirkwood. Congratulations, Caroline Kirkwood. Our team will be in touch with you after the webinar. And obviously, I want to give a big thank you to everyone here at Chargeflow for putting on another great webinar. If you want to forget about chargebacks and win more disputes than ever before, please feel free to reach out to us at chargeflow.io. We'd love to speak with you. And as a special gift on behalf of Chargeflow, we will be giving away $100 worth of platform credits to 5 people out there. So please watch your emails to receive your prize. So with that, I would like to give our panelists today a massive thank you for taking time out of your busy schedules to help the D2C community improve their financials, and ultimately move to the next level. And of course, most importantly, thank you out there for joining us. I really hope it was beneficial and deeply informative. Until next time, keep leveling up.